The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. We've got breaking news on UK GDP and it has matched expectations. December growth, a mighty 0.1%. But the year-on-year figure on GDP output in December only up 0.7%. Welcome to Squawk Box with myself, Steve Sedgwick, Karen Cho and Ben Boulos. And these are your headlines. Well, stateside US stocks giving up an initial bounce as investors digest a mixed jobs report. The headline figure more than double some expectations. There were some on the street who got it right, but growth for last year has been revised lower.
Siemens raises its outlook. The numbers, it posted a 10% jump in first quarter orders. CEO Roland Busch telling us that the company is seeing an AI boost.
The impact in the real world, so in industrial manufacturing, designing of products, or looking at the operations using AI, will come faster than we expect. This is our idea of creating the industrial AI operating system.
Mercedes full-year earnings more than halve as the German automaker takes a €1 billion hit from tariffs costs and flags rising protectionism across key regions. And Softbank notches a fourth straight quarter of profit, boosted by rising valuations of its stakes in AI giants Nvidia and Open AI.
Right, what do you want to talk about? Consumer goods like ice cream and things, or do you want to do UK GDP? Tough, I'm going to do UK GDP. Karen will do that in a minute, the other bit. Okay, even though they're obviously selling the ice cream company, so they've got figures without ice cream. That's Unilever. Okay, so GDP figures up 0.1% month on month, as I mentioned in the heads as well. GDP output up 0.7% versus the expectations of 1.1%. Where are we not growing enough in the UK? I can tell you it's industrial output up only 0.5% year on year, as opposed to Reuters' expectations of 1.5%. That is a stunningly underwhelming figure, as indeed is the manufacturing figure of up 0.5% year on year versus the expectations of up 1.8%. Construction was disappointing again, down 0.3% year on year, as opposed to the Reuters poll for a flat figure. Services output, again, underwhelming, up 0.8% year on year versus the expectations of up 1%. So by and large, the headline December figure is in line. The output figures and the subsectors of industrial, manufacturing, construction and services are underwhelming. The fourth quarter GDP preliminary for the year is coming in at 1%. The Reuters poll had been 1.2%, so a mild downgrading of the growth expectations. Look, these aren't terrible figures. They are just a dash underwhelming, I would suggest as well. But I don't know if you two want to jump in on these.
There was uncertainty at the back end of last year, the upcoming budget that the markets, investors, businesses were concerned about. They felt it was going to be brutal. There was a little bit of holding back, so some of the concerns were felt around that. Macroeconomic factors internationally. I mean, every economy has been able to rely on that and cite some of the tariff and the international concerns. So all bundled up a little bit, I think, as well as some of the other concerns around Jaguar Land Rover as well, too.
I think you've got the headline of the day on the corporate front coming out of Unilever here as well. And this underlying sales growth figure as well. I don't know if you want to break that one, because I don't think that looks very good at all.
I mean, there's a lot happening on the corporate side as well, and that's the point, isn't it? Corporate and the macro are entwined in some ways. Just wading through the numbers now, the full-year adjusted sales growth, 3.5%. The sales, 50.5 billion euros versus estimates of 54.3. So underwhelming on that full-year sales print. Underlying operating margin, 20%. The company announcing a 1.5 billion euros share buyback program. For 2026, growth is expected to be at the bottom end of underlying sales growth range, reflecting slower market conditions. And again, trying to get that sales target, the underlying sales target in line, has been an issue. So the numbers here suggesting that this year is going to be difficult. Anticipating a modest improvement in underlying operating margin for the full year versus that 20% it hit in 2025. So again, the guidance here is going to be an issue for the markets today. Q4 underlying sales growth, 4.2% was the line. They've got a productivity program that is delivering ahead of plan. So they're trying to plug into the announcement today some positives here. Productivity program, the buyback program as well. Also in terms of strategy, and I think this is quite key now as we talk about where some of the fault lines may lie, is saying it's prioritizing the premium segments and digital commerce and anchoring our growth in the US and India. So two of those key markets, US and India, coming through here in terms of their strategy outlook.
So I think this is really interesting in the bigger picture. Everybody's looking for and I'll quote, I don't know, it was US or CNBC or FT, the anything but US tech trade it seems to be on at the moment. And this fits firmly into that category. Consumer staples are what do we want to rely on in this world? Cheap consumer staples. The problem is the likes of this company and its peers on the European continent, they trade at not a particularly cheap price. Unilever trades at 19 times forward. And so when you get a statement like, and I think that's the statement of the day, the one you mentioned there, that actually those figures, the sales figures are going to be at the bottom end of expectations for 2026 as well. When you get that just gives a bit of caution to the anything but US tech trade as well. So you've got good old staples with a 3% dividend yield. It's a good workhorse of a company, but there are problems.
Before we get better, should we just put the stock trade up so you can have a look and you can see how it's gained over the course of this year, about 10% up so far year to date versus the past year. If you stretch it out further, you can see it was a slightly bumpier ride, but that outsized tilt up at the end of the chart suggesting the bounce this year.
Yeah, and interesting, picking up on the anything but tech trade remarks from Steve, that we saw the effects of that being felt in the European markets yesterday. It was the FTSE 100 bucking the trend and ending the session higher with a pivot towards mining and energy stocks, helping lift it, just reflecting that appetite for those, I suppose, AI-insulated sectors.
Yeah, good segue, I think, for the markets too for us there. Let's just take a look at what happened yesterday. We had data stateside, and it was not data Friday, non-farm payrolls Friday. It was non-farm payrolls Wednesday as the market got delayed data. And that was a fairly significant catalyst for quarters of the market. We had 130K build, much stronger than many had anticipated. You felt it in a whole bunch of stocks, just not on the mega caps. So about 300 odd stocks on the S&P 500 rose on hopes of strong economic growth. So you did see elements of the market moving, but the mega caps were pulling back, which is why you saw the major indices also then in the red. Important nuance when you take a look at markets yesterday. So you could see subtle ranges as there was a tug of war between a mass number of stocks versus the big heavyweights that the market tracks. In terms of what we saw on the software side, this was the wash up yesterday. ServiceNow again retreating, Salesforce, Palantir, Snowflake. So again, those fears around obsolescence in the software market have simply not gone away. I want to take you to the Asian markets and the wash up today. The performance we're seeing across on Japanese stocks, it is flat. Hong Kong weaker by 9/10 plus. Shanghai holding onto some green and a much firmer trade again out of the Kospi. That has bounced. I thought very interesting to hear again out of one of the earnings overnight that memory chips and the component charges that you're getting from some of these markets that are going up to compensate for the demand shortfall still very key, and that is a supportive backdrop for that South Korean market. To what we're seeing out of the European futures this morning. Yesterday, as we closed up shop, we were slightly higher by about 0.1%. So small moves there, but it really masked what was a stretch higher for the FTSE 100 this morning. That market, again, looks to be banking more gains this morning. The DAX was weaker along with the French market. Those markets this morning, we're seeing the DAX looking to be heading towards firmer territory along with Italian stocks. Now, US futures, as we gear up for the session stateside, we are setting up for a day that looks to be, I think we saw green patches there on the charts early on this morning. We're looking at DSM as well. But the performance for those US markets, it does look more modest to the upside. The range is small, but it does look like firmer territory, Steve.
Great, Karen, thank you. Look, I'm going to try and say a word on air that should never be mentioned. Methodological. Yes, did it. Methodological changes made the January non-farm payrolls figure complicated. So, January's non-farm payroll was a whipsaw figure for market watchers. The headline number came in at 130,000. That is the strongest growth in more than a year and more than double the 55,000 that Dow Jones had predicted. But job creation for last year was revised dramatically lower to just over 15,000 per month, with the last 6 months of the year, producing a net loss of 1,000 jobs. Now, the 2-year Treasury yield posted its biggest one-day gain since late October on the back of the news. But as I say, there were methodological changes that made it more complicated. Meanwhile, the unemployment rate dipped to 4.3% against expectations. It would hold at 4.4%, potentially shifting focus back to the inflation aspect of the Fed's mandates. I got methodological. I couldn't do expectations. Anyway, expectations for a rate cut at the central bank's next meeting slumped on the back of the data, according to the CME's Fed Watch tool, which now prices in a 1 in 20 chance of a rate reduction versus a 1 in 5 chance on Wednesday. We've spoken to investors and economists about the outlook for the Fed from here.
Our forecast, we don't get any cuts until the middle of the year, but then we have 50 basis points as inflation starts to come down more clearly when we lap the tariff effects in April, May, June. Then in the back half of the year, we think inflation is going to come down, and that will create room for sort of benign cuts back down to the 3% estimate of the neutral rate that the Fed has.
One of the best trades out there right now is betting on more cuts this year than expected.
Which you did last year successfully, too.
Yeah, we've had this on for a bit, but I really think that he's not being brought on to hold the rates at a steady rate. If we have 4 or 5% inflation, sure, then he won't be able to persuade people. But otherwise, he's going to argue productivity. He's going to argue we don't have to cut just because the economy is running hot. I mean, we can cut even if the economy is running hot. And so I think by the time we get to the end of the year, it's going to be substantially more than 2 cuts.
We expect 2 cuts this year under the new chair. We think Jay Powell is done in terms of rate cuts. But I think the data is poised to essentially give the chair what he needs to persuade the committee to cut a couple more times this year.
Well, I said it was complicated, and funny enough, I was looking at Jan Hatzius' research, who was just talking about it there as well. But let's get another view. Jason Granite is a CIO at BNY. Methodological changes meant the street was all over the place on this one. What do you make of it, though, Jason?
I'm impressed with your pronunciation.
Yeah, I couldn't get the word expectation out there.
No, well, but speaking of expectations, obviously the market was expecting a weaker number. There's been a lot of focus on the labor market across policymakers. From my seat at BNY overlooking our balance sheet, we're very focused on the direction of travels of rates. The labor market has been the focus. I think even with this report, we're tracking something like 75,000 jobs over the last 3 months on average, which is above what most economists would say is what we should expect in kind of this new normal, given the immigration story. But I still think we're balanced between labor and inflation, and we might have here shift off the complete focus on labor.
Jason, it's all to play. It's actually quite an exciting movie at the moment. And the other story that I was really interested in yesterday was the non-partisan Congressional Budget Office, which again is another great big mouthful, who basically said the deficit is looking horrible and it's going to get worse to 2036. And of course, Kush Desai, the White House, is saying you got your growth figures wrong. So how much is everybody looking at that side of the budget, the ledger as well?
Yeah, I think this has been a big focus for a long time. I continue to be impressed with your word salad there. But look, some of the rocks that we see in investing are, one of them is this fiscal story. Central banks have gotten out of the business of holding and warehousing a lot of bonds over the last handful of years. Their balance sheets have come down. So the focus is on where all the fiscal goes.
Jason, it's only $6 trillion now or something crazy, isn't it? well, I guess my point is, what's Warsh going to do on that?
Look, there's a long way to run here before Warsh is in the seat. I think there's different ways in which you can have a smaller balance sheet or think about the balance sheet. Number one is you can think of the balance sheet as a percentage of the economy or GDP. And if GDP is growing at the clip that it seems to be growing and the balance sheet isn't really changing, then by default it's shrinking in some capacity. The other way is, right now the portfolio that the Fed owns, most people don't know this, but has longer duration than the average outstanding U.S. Treasuries across, if you compare like for like. And so if they roll into T-bills and they get shorter and the economy grows and they keep the balance sheet growing at a slower pace through these reserve management purchases than the economy is growing, then you have a smaller balance sheet as a percentage of the system, and you have one that is a shorter duration than it was before. And so, most people get kind of tongue twisted as you are with smaller balance sheet, meaning they have to sell or do something, and we just don't see it that way.
Right.
Can I pick up on the growth remarks? Because what we saw back end of last year, 4.4% growth in the third quarter, and then we slowed back, but still above where the Fed thought the growth rate was going to be. That in the context where we had a really mixed picture around the jobs market last year, you'd think that the economy growing that fast would be dragging more hiring into the mix at some stage, creating more jobs, but that just didn't happen. Does that worry you at all?
No, so if you think about the fourth quarter of last year, coming out of the shutdown, a lot of the data and the stuff was reasonably noisy. So to put a lot of weight on that, might not be the best place to look for the heaviest weight on the data. Now, we have a strong, most people are revising their growth estimates up. We've obviously saw the strong job numbers yesterday. Inflation seems to be moving roughly sideways. This is a really constructive backdrop, right? You have good fiscal backdrop.
Constructive for what though? Because if you put this overlay to stock markets, is it constructive for tech stocks for the growth market? Because it doesn't look like we're going to get as many interest rate cuts potentially if the growth rate is that strong. Is it constructive for consumption stocks if we've still got this K-shaped economy and consumers are not spending money because they have job insecurity now?
Yeah, look, the way I think about the environment from a broader perspective, and I sit with my colleagues regularly, we do something called our BNY Institute, where we get the thinkers across the organization together, we publish on this, and the way we think about it is it's very constructive for investing in aggregate. There's going to be winners and losers in the sectors, but when you have fiscal behind, when you have monetary behind, you had mentioned that maybe we'll get stronger growth, but the market is not changing the pricing on where rate cuts are going. We've been sitting around that 2 cuts, and so it still continues to be very constructive for risk assets. Credit spreads are tight. This is a broad, strong investor environment. That being said, diversification paramount.
Jason, just to pick up on one of the remarks that we were making in our opening bit of the show about the anything but tech trade, what's your take on that? Are we seeing a significant shift into anything that is seen as insulated from the onslaught of AI, or is it a temporary, short-term thing?
Yeah, anytime you have new technology or disruptions that come in the market, it's going to be very nonlinear. You've seen this through all the different implementations over time where there's winners, losers, people guess who the winner's going to be, guess who the loser's going to be. The best example I see this is Google. If I was sitting here a year ago, people might have come and said, Google's the biggest loser. What's going to happen with Google? Now Google's seen as a big winner. So calling winners and losers in this journey is probably a little early. But that's not going to change market and traders to go in there and try to do that. For us, this is a longer game, very constructive. We find that AI is a very strong theme and one that'll play out over a long period of time.
And then just to get your thoughts on a story on the day today, actually your note refers to 2026 opening with real uncertainty. Yep. Given the House has voted to overturn the tariffs on Canada, how does that play into your analysis? Does that take away some of the uncertainty or just fuel it even further?
Yeah, so I think that this was somewhat in the base case or somewhere in the very realm of expectations that there would be court rulings that would go against some of these things. And so I think the market was somewhat prepared for a range of those. And I think that the administration has been very clear that they're going to use different paths to kind of stay the course on that. And so I wouldn't expect that to change much.
Okay, Jason, thank you very much. Really
great to be here.
Thoughts. Jason Granite, CIO of BNY. Thank you. And thank you for being with us. Do stick around though. Coming up on the show, fourth quarter profits at DSM Firmenich miss expectations. We'll be joined by the CEO after the break. Plus, Mercedes shares hit reverse pre-market after revealing a €1 billion hit from tariffs last year. And earnings season rolls on. Don't miss our interview with the CEO of Deutsche Börse. That's coming up at 7:30 London time.
Executive Decisions is the new podcast from CNBC, where I ask powerful leaders about their decisions that changed everything. I'm Steve Sedgwick, and here's the CEO of Siemens Energy, Christian Bruch.
business leaders should not stay quiet in a world which is super complex. We sit in a privileged position, and we have to use that to ensure that society remains prosperous, stable, successful.
That's Executive Decisions with me, Steve Sedgwick. Get it wherever you're listening to this.
To some earnings this morning, and DSM Firmenich posted sales of just over 9 billion euros in the first full year, missing FactSet's estimates. The chemicals group also announced a new 500 million euro share buyback program, which will be launched in the first quarter. And joining us now is Dimitri de Vries, who is the CEO of DSM. Dimitri, thank you so much for joining us. And let me just get into the backdrop here for the viewer, because it's been such a huge year for you. You've managed to shift the business in a whole new direction. You've taken out the animal nutrition, a big deal that is still in the works and is meant to close later this year. But you will focus now on human nutrition, health and beauty. Just want to flesh out the road to the pathway that you've arrived at to today.
Yeah, I mean, a pivotal moment. I mean, like it was 3 years, a pivotal moment when we merged DSM and Firmenich. I think we have integrated the company. We have tuned our portfolio. I mean, next to the animal nutrition business, we've also divested marine lipids, yeast extracts, the lower margin, the lower growth business. So, like you said it well, we're ready for the next phase of building DSM Firmenich, really as a consumer-focused company. And you've seen that also been reflected in our full-year results. So we have carved out, we have restated the financials, so you can really see that we are this 9 billion company focused on consumers, and we're now ready to accelerate that.
You still have a stake, though, when it comes to the animal nutrition and health business that you've sold to CVC Capital, a 20% stake, I believe. And one of the issues was still the supply chain problems that we'd witnessed in recent years, the demand for animal feed. What are you seeing on that side? Are you seeing any improvement?
Yeah, so I think it's important to know that we created a deal, and we internally say it's a smart deal. There are also people out there, oh, yeah, we want to see a little bit more, and etc. But I think it was a smart deal where we have mitigated the volatility. The volatility goes with the ANH and the vitamins. However, we also need vitamins for our human category in health, nutrition, and care. Those are different vitamins, different quality levels, different forms, different regulatory approvals. But obviously, we have secured a favorable supply vitamin agreement with the new company. So apart from the fact that we have a 20% ownership, there's also a supply agreement. So it's an important partner for us. The 20% ownership has predominantly to do with the fact that we see huge upward potential for this business, and we want to benefit from that, and we have worked with CVC on many other occasions. They are really great in value creation for that business, and we want to benefit from that. That's why we also kept a 20% stake. But obviously, we are not operational managerial out. We've mitigated the downsides, and we're really going to focus on where, for us as DSM Firmenich, the real value is, and that's on the consumer part of the business.
It's Ben here. Very good to see you, Dimitri. Just to pick up on that, if you see the potential growth on the consumer side, one of the challenges, I suppose, for anyone in the fragrance industry is the rising popularity of copycat dupe fragrances. People find it easily online. They say it's almost exactly the same smells as you'd pay significantly more for. How are you tackling that potential risk?
Yeah, I think it's a fair question. We are really focusing on the prestige part. So if you look at the pyramid, really on the prestige part, we are not into that broader segment in itself. And what we are doing is continuously innovation. We do that via creation, so formulations together with our perfumers, but we also innovate on ingredients. That's also the beauty of the merge of DSM Firmenich, that we bring the science together. And by continuously evolving via new ingredients, and we call them captive ingredients, it's also very difficult to copy that. So it's a deliberate choice to play in that prestige and bring innovation, not only creation, but couple it with innovation on new ingredients.
And in terms of different geographic regions, where do you see the focus for you in this coming year?
Interesting enough is that all three great regions are important to us. So it's Europe, it's Asia, it's the Americas. But I think what is important to know is that we've seen uncertainty in the world creating a bit of cautious consumer behavior, which we have seen being reflected in the second half of last year, more in the North America space than anything else. So we really want to create a little bit of reliability, credibility, but hopefully also a bit less uncertainty in the North American space. And then the 3% growth, which we have tackled for 2025, will then create opportunities to grow further.
Dimitri, good morning to you, sir. I think it's fascinating, your last answer, and I'll follow up on that as well, because it seems to me it's very simple what you and every other globalized company does, and that is stop being globalized and start being regionalized. And everyone I've spoken to is in your kind of position saying, yeah, we have to have manufacturing, R&D in North America for North America as well. That's how we get around the tariffs.
I mean, tariffs plus currency nowadays. So, I mean, you don't see that, but it has quite an impact in Q4. I mean, we know that the dollar is at 118, 119, where normally it was at 110. So it's not only tariffs, it's also currency. Now, I wish I could tell you that there was fantastic visionary insight that we were already preparing local to local 10 years ago. That's not completely true, because we are local to local, but predominantly because our customers want it to be. So if you are a fragrance house in the US, you don't want to be dependent on ingredients coming from Asia or Europe. You want to have it close. Application labs, you work together with customers and you want to be close. You don't want someone traveling from Italy to help you in New Jersey, right? So we wanted to be and had to be already local to local. That setup is helping us now. I sometimes say that there's been visionary, but I think it's partly to do with the infrastructure of the health, nutrition and beauty space we play in.
Yeah, and just one more on the share price as well. Look, it's been a tough road, there's no doubt about it. Looking at the 5-year chart, the high, somewhere in the region of 123. We're now a little bit lower than that, Dimitri, I think it's fair to say. What else do you need to do to get these shares back up? You've got a buyback, you split the business up. What else can be done?
Yeah, I think fair question. I think overall, I mean, this is a competitive race, right? So you always compare with competitors. Now, the bad thing or the good thing is that everybody has been downgraded as an industry sector. Now, are we happy with it? No, but we always want to do better than competition. Now, it's very clear with the integration, with the tuning of the portfolio, we're now ready for the accelerate phase. We've grown 6% in 24 with that consumer business. We've grown 3% in 2025 within a difficult macro environment. So we're now going to grow what we have and anchor what we do after 3 years of tuning, portfolio, integrating. So this is the next phase. And I think I'm very excited to be in that next phase after the A&H signing deal, which we announced on Monday.
Well, do you know what, Dimitri? I think I need to ask you a bit more about your big executive decision. So I'll do that tomorrow, and we'll bring that to viewers at a later time. So, Dimitri, I'm looking forward to our longer chat tomorrow as well. But thank you for joining Karen and Ben and myself this morning. We'll see you tomorrow. Dimitri de Vries, who is the CEO of DSM Firmenich. That is a shameless plug, wasn't it? But there you go. That's what I do. Coming up on the show, we'll have a look at the futures, and then we'll dive into the markets in a bit more detail. Look at that. That is a solid rally. The CAC 40 seemed 1.1% higher.